Okay, imagine this. You're doing well, right? High income, career's moving, you're putting money away for retirement. You didn't think, okay, financial security should be pretty straightforward. More money, more room for error, saving faster, and, for a lot of things, that's dead on. It's true. But here's where it gets kind of fascinating. For one specific, very sought-after retirement account, earning a high income actually puts you, well, at a disadvantage.
It really is a strange situation, isn't it? High income gives you more firepower for saving, obviously, but those advantages aren't universal. There are walls you hit, and one big one is contributing to Roth retirement accounts.
Exactly. That's what we're calling the Roth dilemma here. Roth accounts have this amazing benefit. I mean, tax-free growth and tax-free withdrawals in retirement, that's huge. But then, boom, high earners often find they just can't contribute directly. Income caps. It must feel like getting an invite to a really exclusive party, showing up, and then, nope, your name's not on the list.
Totally. Frustrating is probably an understatement. Which is why this strategy we're talking about, it feels a bit like finding a secret VIP entrance. It opens up tax benefits people thought were just off limits to them.
And that's exactly our mission for this deep dive. We are going deep on one of the smartest moves high earners use for this, the backdoor Roth conversion. We're going to unpack it all. What is it exactly? How does it work? What are the tax implications? And you really need to know those. Plus, the pros, the cons, the actual steps to set one up. And crucially, we need to talk about a potential, let's say, regulatory risk from the IRS you should be aware of. Our goal, give you the fast track to understanding this, well, complex but really valuable strategy.
Okay, so maybe let's just quickly define what a basic Roth conversion is first. Essentially, you're taking money that's in a pre-tax retirement account, think traditional IRA, 401k, maybe a 403b or 457b,
Yep.
and you're moving it into a Roth account. Usually a Roth IRA, sometimes maybe a Roth 401k.
Okay, so a standard conversion is just moving money from pre-tax to Roth. What's the immediate hit there?
Financially speaking. Right. The main thing, the absolute key thing, is that converting usually means paying income tax in the year you do the conversion. You're essentially choosing to pay the tax now on that money, not later in retirement. But the big win, the upside, is that once it's converted, that money can generally grow tax-free and come out tax-free later on. And important note, you can't undo it. Once converted, it's permanent.
Got it. So immediate tax bill, potentially. But the long-term prize is that tax-free status. Now, a backdoor Roth IRA conversion, that's a specific play, isn't it? How's that different from just a regular conversion?
Exactly. It's more specific. A backdoor Roth conversion is really a two-step process done close together. First, you make a non-deductible contribution to a traditional IRA. That means you don't get a tax break for putting the money in. Then, usually pretty quickly after, you convert that traditional IRA contribution into a Roth IRA. It's different because you're starting with after-tax money, not pre-tax money you deducted earlier.
Ah, okay. So if you do it right, this backdoor thing essentially transforms your non-deductible traditional IRA contribution into Roth IRA funds. And those funds then get all the good Roth perks. Tax-free growth, no RMDs, required minimum distributions, and the kicker, you sidestep those income limits for direct Roth contributions. Plus, it's another way to sock away more tax-advantaged money for retirement.
That's the core idea, yes. That's the power play. But, while it sounds simple, contribute, then convert, it can get tricky, especially with the tax rules and even making sure the money has actually settled in the account before you convert. Custodians have rules about that.
Right, and let's talk taxes, because this is where people could really get tripped up. Does a backdoor Roth have tax consequences?
Right.
Big time. And there are like three main things you absolutely have to get your head around. The pro rata rule, the IRA aggregation rule, and this little thing called prorated interest.
Okay, let's start with pro rata. This rule kicks in when you have both pre-tax money and after-tax money mixed together in your traditional IRAs. The IRS basically put this rule in place so you can't just, cherry-pick the after-tax dollars for conversion and dodge taxes on the pre-tax growth. It forces a proportional tax treatment.
So wait, if I understand this, it's not just about the new money I put in, the after-tax stuff. The IRS kind of looks at all my traditional IRA money, pre-tax, after-tax, as one big pot when I do a conversion. That sounds like a major potential pitfall, doesn't it?
It really, really can be. Let's walk through an example that helps. Say you have an old traditional IRA, maybe from a rollover with $100,000 in it, all pre-tax money. Then you make a new $7,000 non-deductible contribution to that same IRA, planning to convert just that $7,000. Now, when you convert the $7,000, you don't pay tax again on the $7,000 principal itself because it was non-deductible, after tax already. But, the pro rata rule says you do pay taxes on a proportional share of the pre-tax money you already had in there.
Okay, hold on. So I put in 7K as free tax, but I've got 100K pre-tax sitting there. My total traditional IRA balance is $107,000. The IRS looks at that and says, okay, about 93% of this pot, 100K, 107K is pre-tax, and only 7%, 7K, 107K is after tax. So even if I only convert the $7,000 I just put in, roughly 93% of that conversion amount is going to be taxable.
You got it. Exactly. It's like the pre-tax money taints the conversion, even of the after-tax contribution. You're taxed proportionally based on the overall mix of pre-tax and after-tax dollars across your traditional IRAs. It's definitely not as simple as just converting the new 7K tax-free.
Wow. Okay. And then it gets even trickier with the IRA aggregation rule. This rule says the pro rata calculation doesn't just apply if the pre-tax and after-tax money are in the same IRA account, right?
That's the key point. The IRA aggregation rule means that for the pro rata calculation, the IRS looks at the balances across all of your traditional IRAs, SEP IRAs, and simple IRAs combined. So even if you open a brand new, clean traditional IRA just for the backdoor contribution, if you have other traditional IRAs holding pre-tax money somewhere else, they all get lumped together for that pro rata math.
So same example, basically.
Yeah.
Let's say I'm smarter, or I think I am. I open a new traditional IRA, put in my $7,000 non-deductible, but I still have that other traditional IRA with 100K pre-tax sitting over there. When I go to convert the $7,000 from the new IRA, nope, still aggregated. The 100K from the other account still factors into the pro rata calculation, and a big chunk of my 7T conversion becomes taxable.
Precisely. The aggregation rule catches that scenario. Now, a quick sidebar on a common strategy here. If you have access to a 401k plan at work that accepts incoming rollovers, you might be able to roll that existing pre-tax IRA money into the 401k. Employer plans like 401ks are generally not included in the IRA aggregation calculation. That can sometimes cleanse your IRA situation for the pro rata rule, but that's a whole other layer of complexity.
It's fascinating. Okay, good tip. And the third tax thing was prorated interest. What's that about?
Right. So when you put money into an IRA, even if it's just for a few days or weeks before you convert it, it usually sits in a money market or high yield savings type fund within the IRA, right?
Yeah.
And it earns a little bit of interest, even if it's just pennies. That interest earned inside the traditional IRAs, yes, the contribution basis is after tax, but any earnings on it while it's in the traditional IRA are pre-tax. So when you convert that tiny bit of interest or any dividends or capital gains, if you actually invested it briefly, that portion is taxable upon conversion. You just need to account for it. It's usually small, but it's part of the calculation.
Okay, so after hearing all that pro rata, aggregation, interest, you might be thinking, man, is this even worth the headache? And, for a lot of people, the answer is still a definite yes, because the advantages can be really, really significant. Let's talk about the upside. What are the big benefits of doing a backdoor Roth? I see four main ones. First, and maybe the most obvious, it lets high-income folks get money into a Roth IRA, period. Like we said, direct contributions are often blocked by income. Roth 401ks usually don't have those income limits, but Roth IRAs do. This is the workaround.
That's number one, for sure. Second advantage. It lets you potentially lock in today's tax rates. We tend to assume our tax rates will be lower in retirement, but that's not always true. If you have large tax-deferred balances, pensions, significant Social Security, your retirement tax rate could actually be higher than your current rate. Doing a Roth conversion now means paying tax at potentially lower rates, hedging against future tax increases.
That's a really good point. Okay, third big advantage, and this is huge for legacy planning.
Yeah.
Avoiding RMDs and maximizing what you leave to heirs. Roth IRAs don't have required minimum distributions during your lifetime. Starting in 2024, Roth 401ks won't either. This means you don't have to take money out if you don't need it. It can just keep growing, potentially for decades, tax-free. That offers a lot of control and flexibility. And for estate planning, it's powerful. Inherited Roth IRAs are generally tax-free for beneficiaries, assuming the account is at least 5 years old. That's a much cleaner inheritance than a pre-tax IRA.
Definitely a major planning benefit. And the fourth advantage is tax diversification. Having money spread across different account types, taxable brokerage accounts, tax-deferred like traditional IRAs 401k, and tax-free like Roths. That gives you incredible flexibility in retirement for managing your withdrawals and your tax bill year to year.
Okay, so tax diversification, unpack that a bit more. How does having those different buckets give someone more power or control in retirement beyond just avoiding RMDs?
It's all about optimizing your income and tax situation each year. Imagine one year you have a big unexpected expense, maybe medical bills, or maybe you sold some stock and have a large capital gain. Having tax-free Roth money means you can pull funds from that bucket without adding to your taxable income for the year. It could keep you in a lower tax bracket overall. Or say you have a year where your income is unusually low. Maybe you delay Social Security. That might be the perfect year to strategically pull some money from your traditional IRA and pay tax on it at a very low rate. This flexibility allows you to be strategic year by year rather than being locked into one withdrawal pattern that might be tax inefficient in certain years.
Gotcha. That makes a lot of sense. Control and optimization. Okay, so we've covered the good stuff, but like any powerful tool, there are downsides, right? Caveats. Let's flip to the disadvantages of doing a Roth conversion, backdoor, or otherwise. What should people be wary of? First one seems pretty obvious. You got to pay the taxes up front on any pre-tax money you convert. If that pro rata rule bites you and you have a decent chunk of the conversion become taxable, you need cash on hand to pay that tax bill come April. You definitely don't want to use the converted IRA money itself to pay the tax, as that can trigger penalties if you're under 59.5. You might even need to sell other investments to cover the tax, which would create its own tax issues.
That's true. The upfront tax is the biggest hurdle, although it's worth repeating. If you're only converting non-deductible contributions, meaning you got no tax break putting the money in, then the conversion of that specific basis amount isn't taxed again. The sting is primarily on any pre-tax money that gets pulled in via pro rata or on any earnings. But converting even that non-deductible basis still gives you the huge benefit of future tax-free growth, which you wouldn't get if you just left it as a non-deductible traditional IRA contribution.
Good clarification. Okay, second disadvantage, withdrawal timing. The 5-year rules. Roth IRAs have rules about when you can take out earnings tax-free and penalty-free, generally after 5 years and age 59.5, or for certain exceptions like a first home purchase. But there's a separate 5-year clock that starts for each conversion you do, specifically regarding avoiding a 10% penalty on withdrawing the converted amount if you're under 59.5. So if you convert money today, you generally need to wait 5 tax years before you can withdraw that specific converted amount penalty-free, even if you meet another exception. Each conversion has its own 5-year waiting period.
Yes, that 5-year rule on conversions is important to track, especially if you think you might need the money sooner rather than later. And the final major downside, or maybe just a critical point, you cannot undo a Roth conversion. Before the big tax law changes in 2017, you used to be able to recharacterize or reverse a Roth conversion if, say, the market tanked right after you converted and paid the tax. Not anymore. Since 2018, once you convert, it's done. Permanent. No takebacks.
Oof. Okay, irreversible. Good to know. So let's say someone's weighed the pros and cons, navigated the tax rules, and decided, yes, a backdoor Roth makes sense for me. How do you actually do it? What are the steps? Seems like 3 main ones. First, you need a traditional IRA. Open one if you don't have one. Second, you make your contribution to that traditional IRA. Make sure it's classified as non-deductible if that's your intent for the backdoor strategy. For 2024 and 2025, the contribution limit is $7,000 plus another $1,000 catch-up if you're 50 or older.
And a really crucial part of that second step, often overlooked, you need to file IRS Form 8606 non-deductible IRAs with your tax return for every year you make a non-deductible contribution. This form is how you officially track your basis of the after-tax money in your traditional IRAs. It's essential proof for the IRS later on when you take distributions or do conversions so you don't get taxed twice on that same money. Don't skip this form.
Absolutely critical. Okay, Form 8606. Got it. And the third step, that's the actual conversion, right? You basically instruct your IRA custodian, the brokerage firm holding the account, to move the assets from your traditional IRA to your Roth IRA. Once the contribution money has settled in the traditional IRA, which might take a few days, you can initiate this transfer. Now, interestingly, you mentioned some advisors suggest waiting. Maybe a bit longer, like a few months between contributing and converting. Why is that?
Yeah, that leads us to this, let's call it a lingering potential risk, the step transaction doctrine. This isn't about the explicit tax rules like pro rata. This is more about how the IRS views the whole maneuver conceptually. The step transaction doctrine is a long-standing legal principle the IRS can use. It allows them to look at a series of formally separate steps and say, hold on, these steps are really just components of one single integrated transaction designed to achieve a specific result. They can essentially collapse the steps together for tax purposes.
Okay, so how does that apply to the backdoor Roth? Contribute, then convert. 2 steps. Are you saying the IRS could argue that this isn't really 2 separate things?
Yes.
That it's all just one integrated plan to get money into a Roth IRA when you're technically ineligible to contribute directly?
That's the potential argument, yes. If the IRS chose to apply the doctrine aggressively here, they could say, look, you contributed knowing you were immediately going to convert. Functionally, this was just an attempt to make a direct Roth contribution, which you're not allowed to do because of your income. If they took that view, the whole thing could be deemed an ineligible contribution.
And what would be the consequence then, if they disallowed it?
The main penalty for making ineligible or excess contributions to a Roth IRA is a 6% excise tax. And that tax applies each year the excess contribution remains in the account. It can add up quickly.
Ouch, 6% per year. Okay. So has the IRS actually done this? Have they cracked down using this doctrine?
Well, here's the current state of play. Historically, and up to now, the IRS has largely seemed to, let's say, tolerate the backdoor Roth. There was even language in a congressional report back around 2017 that seemed to implicitly acknowledge the strategy. So for now, the consensus is that the IRS is effectively allowing it, despite the step transaction doctrine arguably being applicable. They're kind of looking the other way. That's why some advisors suggest waiting a bit between contribution and conversion to make the steps seem more distinct, less like a single integrated transaction. Though there's no official guidance on how long to wait or if waiting even matters.
So it's allowed for now.
Yeah.
But the risk is that the IRS could change its mind, or Congress could change the law explicitly. If they did crack down, what's the likely scenario? Would they go after past conversions?
That's the big unknown. The most conventional approach, if they decided to shut it down, would likely be to only apply penalties or disallow future backdoor conversions. They might grandfather in conversions done under the previous understanding. That seems more typical for tax changes. The more, frankly, draconian and less likely scenario would be if they tried to retroactively apply penalties to past conversions, forcing people to unwind them. That seems highly disruptive and perhaps unlikely, but it's why understanding the step transaction doctrine risk is important, even if most view it as a low probability risk today.
Okay, so a lot to digest there. We've really gone deep into this world of backdoor Roths. We started with why high earners even need this, getting around those Roth IRA income limits. We dug into the mechanics, the crucial tax rules like pro rata and aggregation, and that little interest issue. We weighed the powerful advantages, tax-free growth, avoiding RMDs, estate benefits, tax diversification, against the downsides, the upfront tax potential, the 5-year rules, the irreversibility. Walk through the setup steps, including that vital form, AD 606, and importantly, flag that potential, though currently quiet, risk from the step transaction doctrine.
Right. And it's crucial to remember this has all been for your education, to empower you with knowledge. But this stuff is complex and everyone's situation is unique. So before you actually do anything, it's always a good idea to talk with a qualified financial advisor or tax professional. They can look at your specific numbers, your goals, and help you figure out if a backdoor Roth conversion is truly the right move for you.
Absolutely sound advice. So as we wrap up, here's something to think about. Notice how these backdoor strategies pop up, right? Are clever responses, really, to the complex rules and twists in our tax code. If digging into the details like this can uncover a smart path for retirement savings, well, it makes you wonder, doesn't it? What other areas of your financial life, or maybe even your career or business, might have hidden opportunities? What happens if you really dive deep into understanding the rules of the game in those areas, looking for those, let's call them creative or strategic solutions that emerge from knowing the system inside and out? Makes you think.